So don't use your cash to buy real estate. Use somebody else's cash. What I mean is when you're buying an investment property, and even when you're buying a primary, most people, if you're not paying cash, they're trying to leverage. VA loan, 100%, FHA, 3.5% down, Fannie Freddie, 3 to 5% down, USDA, if you do those, it's 0 down, jumbo, things like that. You can put down 10%, 5%, 20%, right? And then it goes on. But when you're buying a real estate investment property, and you want to really know the hack, you want to know what the pros do, you really want to know, you're like, what do those guys do that have all these projects going on? Do they really have that much money? Like they're that rich? The answer is no, they're not. Most of the guys you see doing 10, 20, 30, 40, 50 plus flips a year, they're putting down probably 5, 10%, if that. When you're seeing guys building all these things, ADUs and stuff, they are leveraging other people's money. And you might ask yourself, well, why doesn't everybody do this then? And in this video today, I'm gonna break down some of the different products that are out there that a lot of people don't know about that you can take advantage of, how you can take advantage of them, and what kind of experience or any do you need to take advantage. And by the way, if we never met, my name is Kenny Simpson. I focus on 1 to 4 unit financing. So that means if you're buying or refinancing a 1 to 4 unit property, it could be a primary second home investment property, I can help you out. I've been doing that for over 20 years, helped over 5,000 clients, funded billions of dollars of loans, and I make videos like this so I can just simply explain and help you out because I do this all day, every day long. Whether I'm helping the real estate investor put down 10% to buy the property and fund the rehab or building or whatever it is, we do that. Or I'm helping the first-time home buyer. Maybe I'm helping the vet that had a VA that needs to use their VA to buy a house. Or I'm helping the self-employed person that got denied by 2 banks that wants to go buy a $3 million house here in California that has great credit, great income and all that, but can't. I do mortgages all day long. And we tend to forget that in our industry, what we do is we just assume people know. Even people that buy real estate all the time, that might be active, a lot of them are not even utilizing this tool, this mortgage, this method. Why? Because they don't know. Maybe they think it's too expensive. Maybe they're not understanding that they can scale this way. So today I'm going to go through what kind of products there are, how do you qualify for the products, and how my clients, not just what I think, and how my clients I've helped introduce this product and scale, or they're just doing it on their own. So number one, there's kind of 3 products I want to focus on today. Number 1, you might have heard of a bridge loan. Number 2, you might have heard of a fix and flip loan. And number 3, you might have heard of a construction loan. Some of those are almost all tied into one, but I'm going to break down each one of them. Number 1, a bridge loan. What in the hell is a bridge loan? Typically, a bridge loan is you're buying an investment property. You're buying it because number 1, you need to close quickly like cash. Number 2, the property could be a dump, a shithole. It has problems, issues. 2. And number 3 is maybe you're really experienced. Maybe you just want to put minimum down. You want to buy the property, and then you maybe just want to take your own funds, rehab it, push the value because you're buying at a deal. You're pushing the value to where you know that it's going to go to, and then you'll just refi out. So number 1, bridge loans, 10% down. You have some history of doing deals and stuff like that. Definitely can help you out there. And what do? We take it out with a DSCR loan, a full doc loan, a bank statement loan. It just depends, right? There's many options. Option number 2 we talked about is a fix and flip. You might have heard about a fix and flip loan. So what does that mean? Does it mean you have to buy the house, fix it up and sell it? No, it doesn't. It's just called a fix and flip loan because a lot of people that do fix and flips do fix and flip properties. This is what they use. So typically, let's say you're going to buy a house for $500,000. I'll just use a round number. $500,000. You got to put down 10%. Then the rehab on this house is going to be $100,000. Great. Then the future value of this house is going to be $800,000. So what we would do is, depends on where we go, depends on your experience, and depends on what you're looking to do. We could potentially take you to a lender where you're going to put down 10% down of the deposit. You're going to put 10% down of the rehab, and then you got to come in with the closing costs and you got to make your payment. We have also fix and flip loans where you put 10% down of the deposit. Then you can put 10% down of the rehab. You're going to put 10% down of an interest reserve, if it makes sense, and then you pay your closing cost, right? And then obviously you have loans where maybe you just, maybe you're not that experienced, and so you're going to put 10% down. Maybe you have to put 15 or 20% depending on your project, depending on what you're doing, until you get more experience. What does experience mean? At the top level, a lot of these fix and flip lenders and construction lenders are looking that you've done probably 3 deals in the last 10 years. You could have bought a deal, you could have flipped it. You could have bought a deal, you could have held it. That's what we're looking for. That kind of active person is going to get rewarded. You're going to get rewarded. Potentially, we can bring down the fees. We can get you better rates. We can get you longer terms. And then obviously, when you go more and more and more, we can get you quicker turn times. And then we can help you scale. The third loan I want to talk about is the construction loan. So let me just stop for a minute. We've talked about 3 loans so far. The third one I'm going to describe. The first loan is a bridge loan. The second loan is a fix and flip, and the third one is a construction. You're like, well, Kenny, isn't a fix and flip loan a construction? Not necessarily, because a fix and flip lender might put you in a bucket and says, oh, a fix and flip means you're buying a house for $500,000. You're going to put $100,000 in, cosmetically fix it up, and then you're going to sell it for $800,000. Construction loan could be like, you're going to buy a house, you're going to rehab, but then you might add square footage. You might add a second story. You might buy a 2-unit and add 2 ADUs. You might buy a house and add 3 ADUs. Do you understand what I'm saying? You might have to build an apartment building. Whatever it is, construction loans can be many different ways. But the one I'm talking about here is somebody really focusing on the 1 to 4, kind of that range of construction. So maybe you're going to buy a house, remodel it, add square footage, or buy a house and add ADUs on it. It's typically going to require different experience in a bridge loan, different experience in a fix and flip loan, because they're looking, have you built anything? Have you done this? Does that mean on a bridge, fix and flip, and a construction loan, if you have 0 experience, does that mean you can't qualify? Absolutely not. Does it mean that somebody's done 30 deals in the last 3 years, they might get better terms than you? Absolutely, and you would expect that too. Why? Because they have proven, I've done 30 deals, I've either paid you off, I've either sold the property, so they've known from start to finish, you bought a property, you fixed it up, you made your payments on time, you paid us off, and you move on to the next deal. That's what all these lenders are looking at. The more you do that, the more confident and the more comfortable they get with you and the more they're willing to give. So on either of these deals, how does it work? It's pretty simple. Do you need to qualify with W-2, self-employed income, tax returns, bank statement income? No. Okay. Do you need to qualify with experience? Not necessarily, so I'm going to say no. Does experience help? Absolutely. Absolutely. Do you have to have money to put down on the fix and flip to buy the property? Absolutely. Does it need to be seasoned in your account for a certain amount of time? Not necessarily. So see, this is a little different than conventional. So you don't need a job. You could just have the money in your account or get it from somewhere else. And then secondly is, what is the most important thing that all 3 of these are looking for? Number 1, outside of experience, outside credit, outside the assets and all that, let's put that aside. What is the main factors of a bridge loan, of a fix and flip loan, and a construction loan? And I'll tell you, here's a couple important things you need to take away. Number 1 important thing is the future value. We call it ARV, which stands for after repair value. Why is that important? Because look, if you're going to buy a property for $500, you're going to put $100 in, and it's going to sell for $800. We have to hit a certain threshold on loan to cost, and then on future loan to value. What is loan to cost? A loan cost would be, you have a $500,000 purchase, you're going to put $100,000 into it. So the loan to cost is, I buy for $500 and then I have $100,000. So it's $600,000 in this deal. They might lend you 90% of that. Then they're going to want to make sure the future value, if it's $800, you're going to hit a 70, 75, depending on where you're at, maybe an 80% loan to value of future. Remember, the more experience, the more you've done, the more they're going to give you. Obviously, they're going to give somebody more leverage that has a proven track record rather than somebody, this is their first deal. Also, the budget. So, are you going to do this yourself? Do you have a contract? Do you have experience? Most of these people, they're looking for a contractor, especially on construction. Where's the contractor? Where's the budget? They're going to look at the budget. Does it make sense? Does it look like it's a shitty budget? Does it look like you actually put time into it? Is this real? They're going to look at it. Why do they care about the budget? Because fix and flip lenders, bridge lenders, and construction lenders, what is the important thing? What do they want? They are in the business of lending you money and getting paid off. They're not in the business of taking back a project and dealing with all the headaches and things like that. I just paid off a loan yesterday that my client bought by a fix and flip loan that went bad. He got a great deal. The investors, well, they got their legs cut off and they lost money, but they're out now. So they want to make sure, number 1, you have a good buy, the future value's there, and also the budget that you're going to do, it makes sense. If you say you're going to spend $50,000 and they're like, $50,000 not going to get the value there, it looks like 100, they're going to counter. This is going to make sense. So it's pretty simple. It's very easy. And the last thing you might think is, hey, Kenny, What kind of credit scores you need? Obviously, the better credit, the better the rate. So if you have a 680 score, you're not going to get the same pricing if you have a 780 score. It's just like everything else. The other factor that matters is, yes, they want to make sure you've got the assets to close, wherever those are coming from. You got the budget, we got the future value, do you have experience or not? And then last but not least is, how fast can you close these? Well, it depends. Some of the fix and flip lenders, they can literally close in 7 days. Some of them are 10 days. Some of them are 21 days. Some of them are 15 days. The longer ones typically because the longer turn times typically are because those lenders have better turn times. Those lenders have better interest rates and better terms. So they're busier, they're just slower. The guy that might have a 9.5% rate compared to an 8.5% rate, he could probably close faster, right? Or a 10% rate. So it really depends on. If you are looking for the best rate and the best term and you have no experience, you might not get that. You might get that after your second or third flip with them, yes. Are things more negotiable as you go down the road and get more business to somebody? Absolutely. Can we negotiate down things? Absolutely. To kind of wrap all this up is, I talked about 3 loans: bridge loan, fix and flip loan, and construction loan. We all talked about, do you have to necessarily have experience? No. Do you have to have a job, income of that? Absolutely no. Do you need assets to put down? Yes. Could they require other reserves just to make sure you can make the payment and stuff? Sure, they could absolutely. They don't want to just lend where you have no money left, right? It could be a problem. So if you've heard of these loans, you're using them, then you understand the power of this. If you've never heard of these loans and you're interested in talking more about it, hit me up, book a call, let's talk about it. The one thing I will tell you, what I'll leave you with, is scaling. I have turned people onto this that were doing stuff with their own money and trying to do it, and they can only do one project at a time. When you learn the power of this leverage and you realize, I can use myself, the asset that's done a lot of these deals, have a proven track record, and you can go to these lenders, you can start doing 2, 3, 4, 5 deals at a time. Yes, you can. And then that's how you maybe you're trying to get out of a job or quit your W-2 job or quit this other thing and you want to go full-time flipping homes or building ADUs or development or things like that, raising money, whatever it is. You can do that. There's definitely an opportunity there to do that, but you got to remember, the more experienced you are, the more you're going to get in these deals. Lenders love, love, love experience. But if you want to scale and you're trying to build a real estate portfolio and you want to fix properties and sell them, or you want to fix them and keep them, we can teach you a strategy. We get you out a fix and flip loan. You push that equity. We come back. You can do a cash out refi to recoup some of your funds if it's there. Like some of my clients, you could do a rate and term just to obviously get out of that higher rate and get the cash flow. And you could build a real estate portfolio like that. And a lot of guys around you that are building these real estate portfolios that do this full time, sometimes they have 10% of the money in, 5% of the money in, 0% of the money. It depends on what they can raise, what they can do on the back end. But this is how they're building it. They are using their talents. Their talents are, I'm able to find the deals. I'm able to use my entire team and my resources to fix a deal up quickly. And then I'm able to work with a broker, a lender, and they're able to get me good financing and then good takeout financing. And that is the key to scaling. And the teamwork makes the dream work in this case. So if you're interested in doing that, hit me up. Love to talk to you about this. And if you've never done one of these, you think, oh, these are expensive, doesn't make sense. It actually does make sense, because the guy that's out scaling you, outperforming you, and outgrowing you, they're most likely doing this unless they just have unlimited money like a Warren Buffett. So anyways, guys, as always, thanks for watching. Share this with somebody. And next week, we'll see you guys soon.